It's very tough. So I think unless you're a revenue generating, profitable, growing company, there is an upper cap on valuation, broadly speaking. So in the logic behind it from an investor's perspective is that for the risk that the business entails when a seed investor or an angel investor is entering, we would not like to play the risk if we are not able to see 2.5, 3 times our money at the next round. We're not playing for 20-30% returns over an 18 to 24 month period and taking angel risk that you can probably get in the stock market. The reason you want 2.5, 3 times your money is because 2 out of 3 companies fail. Not because we want to get a disproportionate pound of flesh from one particular company. So to budget for a portfolio risk, we tend to take a position where we think there is a fair expectation of 2.5, 3 times our money, if not more, at the next round. And then, unfortunately, there's no better way to do this than take, therefore, your estimate of where you think your value creation will be 18 months from now and simply divide it by 2.5 or 3. So most people will not be able to raise Series A money at much higher than $5, $6, $7 million pre-money valuations, period, right? And that's the nature of the market in India as it stands today. Unless you're getting exceptional traction and great business. There are exceptions to this. Recently, Capillary raised a $15 million round. We're hoping 2 or 3 of our companies raise a $5, $6 million round, which means that you probably will get valued at $10 million. But that is an extraordinary outcome. You can't budget that upfront. I'm not going to believe that the entrepreneur says, I will be at $10 million at Series A. It doesn't mean anything that promise doesn't mean anything when we enter, right? So if we are entering and we look at a very favorable outcome to be a $5, $6 million pre-money valuation, it's very likely that we're going to divide that number by a factor of 2, 2.5, 3, 3.5, 4, a range of maybe 2 to 4 to estimate the risk in our head and then use that as the post-money valuation of our round, right? So this is our trade secret, right? So I'm just revealing, let's say this is Blume's trade secret. It could be very different from fund to fund. What we then are doing is this is a top-down approach. If you do market sizing and if you do any estimation of anything, this is what you would typically call a top-down approach. The bottoms-up approach is, what is the team comprised of? What is the caliber of the team? Are there 23-year-olds who require a lot of hand-holding and their genius is otherwise on the product? Or are there 35-year-olds who are mature, who have all the energy to deliver product, marketing, finance, etc.? How many founders? 1 founder, 2 founders, 3 founders? How much money has gone into the business? How much traction has been developed? All of these are factors that you would put on top of the figure 0 to arrive at the pre-money valuation. So if somebody comes to me very blatantly, let's give you an example. If somebody has brought the same business plan, same traction, 2 sets of people came, 1 came with a 2-member team and 1 came with a 3-member team, it's likely that the 3-member team might get away with a 10-15% premium on valuation. Because the odds of failure or the odds of getting to the next round have improved in a favorable condition. The odds of failure have either reduced or the odds of the possibility of getting to the next round have possibly improved. So you're effectively budgeting these kind of probabilities to arrive at valuation. So fundamentally, I think expectations have to be set depending on the size of the round and which stage you are in, to be somewhere between $600,000 and $2.5 million. Most angel seed investments will get done at this space in India, irrespective of who you are. If you're better than that, you're probably ready for $1 million check from a VC. So let's recognize that and assume that you can go and raise that $1 million at a $3, $4, $5 million valuation, rather than try to get into a dispute with a set of angel and seed investors for a much smaller number. The second is, in principle, most people will seek a equity stake of 15, 20, 25, 30%, depending on the amount of capital you're raising again and the stage at which you are. That also tends to dictate valuation. You can't come and say, I will raise 1 crore for 15% and 2 crores also for 15%. It's unlikely. You're probably going to get that 2 crores for 25%. So it might not be directly proportional, but there will be an impact based on how much capital you're raising. So it's a function of how prepared the team is, what the market expectation of where you might be in the next round is, how much money you're raising, and of course the market environment and the investor you're speaking to. So the revenue numbers at seed are so small that they're not material for you to apply a market variable or multiple on it. Fundamentally, we are still looking at the ability to extrapolate where this business might be 18 to 24 months from now. And so a revenue number and a set of customers only gives you a little bit more confidence that that number will be achieved. And on the basis of which you're willing to give a revenue multiple perhaps, right? So if you're not going to be able to say that with confidence this can become 5 times its revenue, it's unlikely that you will give a very rich multiple. You might give a very small multiple. And the multiple might not matter. Like if you have a 50 lakh or a 20 lakh revenue number, what kind of multiple are you going to put on it to justify valuation? It's unlikely that you will be able to. So if you have revenue profits, you're probably going to be on the right side of that scale. That's the only sort of concession you're going to get for having performed and having shown proof of concept. It's not going to dramatically change your valuation into 3 or 4 times or go outside this range per se. You're likely to be on the higher end of this range.